Welcome to Powerhouse, where we interview the biggest names in housing and ask them about their strategy for growth. I'm Diego Sanchez, president of HousingWire, and my guest today is Susan Milazzo, outgoing CEO of the California Mortgage Bankers Association. Susan, it's so great to have you on the show.
Thank you so much. It's an honor to be a guest on the show, Diego. Thank you.
We're going to have a great conversation. Susan, you've led the California Mortgage Bankers Association for over 20 years, which is amazing. What are some of the most significant changes that you've witnessed in the mortgage industry during your tenure?
Wow. Well, I came into this position in the early 2000s. I was actually consultant for them for a little bit before I came on in this role. And I would say that the biggest change that I've seen, and I would say that anybody in the mortgage industry would agree with this, is just the adoption of technology. There's so much technology used in every aspect of the life cycle of a loan. And, all those years ago, when you say outgoing CEO, I'm like, yeah, it is. All this is happening. It's kind of weird. But there was not as much technology used, certainly not the multiple aspects of technology that all have to be integrated for the end result. And, of course, with the adoption of technology comes, more oversight. There's more oversight by regulators on your use of technology, all for eyes on consumer protection, but also they want to make sure that the mortgage industry is evaluating kind of their outreach to consumers, the products they're offering. So I would say the biggest change that I have seen is really this incredible adoption of technology.
Yeah,
I think I have to say, I will just add to that. I have a bit of a theory on that. It seems like we went through the financial crisis, in 07, 08. And as you know, I mean, the industry was kind of just trying to limp along and keep the doors open that they could for so long. But at that same time, other industries were adopting more technology. And I think it wasn't until we really rose from the ashes of the financial crisis where now we can say, all right, now we're going to dig in, we're going to do things better and more efficient. And I think that that's like the trajectory of growth in the last decade, really, in mortgage technologies, where I think it's been really concentrated.
I joined HousingWire a little over 7 years ago, and it did seem like an industry that was sort of continuously under disruption and maybe a little bit behind in terms of that technological progress. And one of the tensions that I've noticed, and I'd love to get your perspective on it, is with the adoption of technology, at least in mortgage, it seems like the cost to originate is still going up or staying higher than you would expect it to be with people adopting so much technology. What do you think is behind that tension there?
Yeah, I wish I knew the answer to that. I will say that, based on the conversations that I've had with my IMB lenders, the cost, all of this technology does costs money, right? And we're not at a point where, loan officers aren't going away. That's certainly the biggest component of the cost to originate a loan, right? Still LO comp. I think that there has been a challenge on the integration of all of these solutions. So a lender will see all of these things. I need this too. This will be great. But how do all of those things work together efficiently? And I'm not sure that the industry hasn't quite solved all of that. I think we constantly make improvements to it, but I'm just not sure that has fully, that's been fully integrated. I think maybe over the last handful of years where there's younger people coming into the market or into the industry, people that are of my generation probably were slow to adopt some of the technology. I've been doing this for years. I'm going to keep doing it the way I'm doing it. They can't tell me what to do, because you're, as an owner, you can buy all this technology, but your challenge is, of course, is to get your team to start using it and using it efficiently. I would say on top of that, the cost for compliance has just multiple times over increased in the years that I've had this job, Diego. I remember, again, kind of looking back from the financial crisis. And of course, it was not inappropriate to have more regulation in the industry, but the cost for that went from, I remember a decent sized IMB at the time saying, gosh, I had one person that was doing compliance, and now I have a department that is multiple people and more technology and more use. So I think that the cost to originate a loan is still higher than it needs to be. I think the industry needs to continue to look for efficiencies to increase that margin.
Yeah, my sense is the kind of spaghetti of technology where you're, putting some new things in, trying to take some other things out, and layering some other stuff on top of all of it. It has contributed to the cost, and I think you're right about regulation. That certainly is an area where folks have to spend to stay in compliance. And on that regulatory issue, we've recently seen a pullback in terms of national regulation of mortgage, but that maybe is accompanied by some states leaning in when it comes to regulation. Do you think those costs will change or grow or shrink over the next couple of years? While we're in Trump 2.0?
I think that lenders know that there are still laws on the books that they have to comply with. I don't think anybody, at least the lenders that I've talked to, aren't interested in rolling anything back. They know that these are the laws. In California, I think the response that we have seen from the change in the federal government in this year has not necessarily been in the form of additional regulation. We already have a pretty strong regulator in our state, and they are we have a great relationship with them. We're very transparent. We help them implement a lot of the things that they would like to see happen in California for lenders under consumer protection. But I think as far as regulatory provisions, we're not seeing a whole lot of change in California. We are, however, seeing it from a legislative standpoint. I think the California legislature has taken some stands this year, and specifically citing their concern over what's happening at the federal government. They want to make sure that California consumers are protected. We've seen legislation this year including CRA requirements for non-depository banks, for non-depositories, IMBs, the enforcement, the state regulator enforcement of UDAP, automated decision-making tools. I think those are all issues that we've seen before, but I think that there was a renewed interest in them this year in California because of what they perceive as happening at the federal level. And we're in the first year of a 2-year legislative cycle in California. So some of the things that were not successful this year don't mean that they won't be introduced or carried on in the second year, 2026 of our 2-year legislative cycle.
So we've talked about the increased costs, technology being such a big focus for the California Mortgage Bankers Association. Do you think AI can help with this concept of the spaghetti technology stack and with regulatory issues in terms of those increasing costs?
That's a great question. I certainly have lots of conversations with people that convince me that that's what's happening. And the logic behind it sounds plausible, right? I mean, if you can build artificial intelligence to direct the use of the technology you have, or make it more streamlined or efficient, cut down the cost, the time it takes to produce certain reports or algorithms or things that you need, that stands to reason that should be reducing your cost to originate, or at least making more efficiency, creating more efficiencies within the technology solutions that you already have with your company. Now, things to be cautious of are that regulators are really looking to what you're using that artificial intelligence for, right? Because what's their job? Their job is consumer protection. So they want to make sure, especially like, as I'd mentioned, automated decision-making tools, especially when it comes to mortgage credit. Is there any inherent bias in that AI that you're using in that automated decision-making? Now, that bill that I'm referring to really kind of it wasn't just focused on mortgage industry. It impacted many industries. However, in the mortgage industry, we're in a bit of a unique situation in that we've been using automated underwriting for years and years and years. Why do we use it? Because there are statistics that show it removes human bias from the underwriting decisions, right? So our mission with that was really to kind of educate the author of that bill that we use automated decision making tool, but we've proven that it does provide it removes the bias from any decision making. So when it comes to mortgage credit, so we think that AI definitely is only getting bigger and stronger, is going to be used in many, many different ways. I can't think of one technology solution that has anything to do with organization that doesn't have an element of artificial intelligence in it right now. I mean, it is, if you're not doing it, you're behind the race for sure.
So under your leadership, the California Mortgage Bankers Association has really solidified its role as the voice of mortgage in California and really beyond. Like there are some areas, especially with technology, where you're more of a national voice, really. Can you share some of the advocacy efforts that you are most proud of over your tenure?
Yeah, thank you so much. I think I will start out. Thank you for the question. The California MBA does have a big footprint in the country, and it is in large part that we represent. Depends on who you ask, right? 20% of the mortgage market in the country. We have full-time legislature that has a never-ending flow of bad ideas to introduce in the legislature that we have to work on every year. But we're also mindful of the fact that what happens in California is often replicated in other states. So we're always, again, very mindful of that. And we have a very strong relationship with the National MBA, who's been incredibly helpful in our legislative successes over the years. As I think about a couple of things to point out, there's so many. I mean, we review thousands of bills every year to find out which ones impact the real estate finance industry, both residential and commercial. And it seems like every year, it is a whole new battleground, right? But if I had to point out a couple of things that I look back on and am very proud of. And again, with an eye just to represent the mortgage industry and do what's best for them and the consumers that they serve. We worked on a bill during COVID, which is a very difficult time, as we all recall. And from a legislative advocacy perspective, it was very, very unique. But we had a bill, AB 2501 by Senator Lamone, who was then chair of Assembly she's senator now, she was Assembly member then, chair of Assembly Banking Committee. It was part of the COVID package of bills that came out in probably every legislature that we had a significant number. It was kind of the CARES Act on steroids. It had an automatic 180-day forbearance for anyone impacted by COVID. Well, everybody was impacted by COVID, with an automatic renewal of another 180 days, just as long as there was a COVID-19 declared emergency. Well, think back to the the spring of 2020. Nobody had any idea how long the COVID emergency was going to last. Some people said it's going to be a couple of weeks. Some said this is going to be, years. We had no idea. Any mortgages that were 60-day delinquents, automatic forbearance. Servicers could not commence on any, recording of notice of default or anything during that time. No penalties, no late fees. Servicers had to provide all borrowers with all of their loan modification options up front, which is of course impossible. There's information and processes you have to go to know what they can provide. And I think that part of the biggest problem, and again, this is as it was originally introduced, is that among the penalties for servicers who violate any of the, and it was kind of a ticky tacky list of like, you have to give this much notice, you have to make sure they know this, you have to provide this to borrowers. Among the penalties for a servicer that violated any one of those was they forfeit the right to ever foreclose on the property. So obviously, extremely problematic for the industry. And we had a very long slog battle in 2020 on that bill. We asked for compliance with the bill for servicers that were complying with the CARES Act. It was already a measure that was passed. We were trying to get, just some, unison across the state and federal laws at that point. Ultimately, the author wasn't successful, and she ended up pulling the bill. Part of that was due to the fact that we worked closely with the National Mortgage Bankers Association, and we commissioned a study done by the Urban Institute that really showed, all the things that that the mortgage industry does to benefit borrowers. And I think that really that bill stands out mostly because the time during COVID, again, working from a legislative standpoint, everything changed overnight. Everything shut down. And I know we're all running our businesses, and that's one thing. But when your job is to monitor legislation that's happening in a state the size of California, the Capitol shuts down, hearings aren't held the way they are, your lobbyist doesn't have the ability to go in and have a conversation with any policymaker or any staff. There's ways that you can call into a committee to voice your opinion, and sometimes your calls would get cut off and you would never have an opportunity to. So it was so much uncertainty at that time. I don't think a day went by 7 days a week where I was not in touch with the National MBA. We were just always in touch on that. Again, ultimately we were successful, but it was a big battle for sure. I think the other point, again, a victory for the National MBA as well, is in 2022, same legislator, now she's in the Senate, Senator Lamone, SB 1176, would have introduced Community Reinvestment Act for non-depository. This is actually the instance in where the Urban Institute study that we commissioned with the National MBA really came into place, because while the author wanted to make sure depositories already have Community Reinvestment Act, we know that you're investing in, low to moderate income and minority borrowers. But we were trying to, we wanted to articulate to her, and we were able to do that through the study, is that IMBs provide the vast majority of mortgage credit to minorities and low to moderate income borrowers already. We are already doing this. And, the additional, compliance burdens, again, going back to your question about the cost to originate a loan, you're driving up the cost for the companies that are providing mortgage credit to first-time home buyers in this minority and low to moderate income, categories and demographic. You should be supporting their efforts rather than trying to penalize them for something that they're already doing. And part of the fines for noncompliance for the first CRA bill was $100,000. So it's a huge bill that we worked on, and we were happy that that did not go any farther. But we did see a CRA bill this year. Again, kind of going back to your question about what's happening in the states based on what we're seeing in the federal government. That bill this year, the CRA bill, was also not successful. The author didn't have the votes. However, we are working with that author over the interim to really dig deeper into what it is that she'd like to accomplish and how can we support that. There might be down payment assistance programs, or there might be some other way that we can, help her achieve her goals. So we are working on that this year. But I'd have to say two of the more recent success stories I would say would be on the bill from 2020 and then 2022 with the CRA.
Yeah, I remember that Urban Institute study and research, super interesting, about how IMBs are already kind of doing what those bills were proposing. Really, really interesting stuff.
Yeah, we had to be careful. We were like, you've come up with a solution that's looking for a problem. We're not the problem.
Right. Yeah. Yeah, I love that. All right, so I mentioned at the beginning of the episode that you are the outgoing CEO of the California Mortgage Bankers Association. Who is the incoming CEO, and how is that transition process going?
Oh my gosh. So the incoming CEO is Paul Gigliotti, who I'm sure many of you know. Paul's been a national figure in the mortgage industry for many years. Paul's been a member of our organization for 10 years. He's been on the board for 6, so he's been in our leadership already. Paul's got a very unique background. He started out in finance. He's worked in the technology industry, and then has had several positions, including running IMBs. He's also worked for mortgage technology, so he's kind of had his fingers in a lot of aspects of our industry already. Paul's got incredible energy and enthusiasm for this job. We joke when we met 10 years ago, he was kind of, I'm like, what is your job? And I was saying, well, this is what the association does, and legislative stuff we do. And, we host conferences. And he's like, that's a really great job. I mean, he was interested in it then. I'm like, I remember that. Like, you wanted this job a long time ago. So we're very excited to have Paul on board. He's got a lot of great ideas to kind of take the foundation that I've built with the California MBA and just continue to elevate it and to continue to innovate the things that we do, really engage with our members and make it easier for members to be a part, an active part of the association.
Yeah, I remember when the news came out that he was going to become CEO. I was like, oh, that's kind of perfect because his background is in origination and in mortgage technology, which it seems like an intersection that the California MBA is really comfortable with and really advocates around.
Yeah, it's great. We've had a great time getting him, onboarded and kind of familiar with, with just the machinations of the association. But he's, like I say, he's already got incredible ideas on new things that he's going to bring to the California MBA. So I'm excited to watch all of this. I do get to be a consultant for the association for another year, so I'll kind of be around. But very excited to see what he does with the association.
Well, let's talk about that that time as a consultant and your transition into being retired from the California MBA. I don't know if you're going to be doing something next, if you've talked about that yet, but tell us about how you're thinking about that consulting period and then what comes next after that.
Yeah. So I was very happy when my board asked me to consider staying on just to, support Paul and make sure that there's a really smooth transition. When anybody's had this job as long as I have, I think that was important. I'm still going to work on the success of our technology event, our Mortgage Innovators Conference, which HousingWire has been a part of. So I'm excited about that. I think that, being able to kind of be Paul's right hand and make sure that, I can help answer questions or kind of give him some guidance that will continue, again, to grow the organization is very exciting. For me personally, I think that I'm going to look at this as kind of a nice exit ramp. I don't know that I'm not looking for another full-time job. My husband retired a couple of years ago, so he's ready. He's like, okay, I'm ready for you to be done here. And so we can go off and do all the things that we like to do. We're both huge. We love to camp. And so we're waiting on a new RV that we bought. Ooh. So we're going to be touring our beautiful country and visiting a bunch of friends along the way. I'm just looking forward to kind of having my own time. This was obviously a very full-time job. I was self-employed for 13 years before I did this. And so I honestly can't think of a time that I just had to, focus on the things that I love, like to play sports, like to, golf and swim and pickleball. And I play guitar and knit and all the things that require practice. They're like, well, you'd be better at it if you just practice. I'm like, this is all I got. I don't have any time to do any of this stuff. So kind of just, looking forward to what slowing down a little bit and seeing what the world offers me next.
Well, I'm envious of that. That sounds amazing. And what a blessing to be able to stick around for a little bit to help with the transition. I feel like that's a pretty unusual and unique setup.
It was I was extremely grateful. I will say that, as you know, I am looking forward to, I mean, nervously looking forward to this next chapter of my life, because I don't know what it's like not to be completely, gangbusters all the time. But I love this organization and I love this industry, and it has been the best job I could I could have ever hoped for. And I'm so grateful to be able to continue to support them in this role. And like I say, just kind of watch the great things that Paul Gigliotti is bringing to the California MBA.
Well, Susan, this has been a wonderful conversation. Really appreciate you taking the time to catch up with me today. Thank you for joining me on Powerhouse.
Thank you so much. It's been my honor.